Hello, listeners. Thank you very much for tuning in to this symposium event that OMFIF it has been putting on yesterday and throughout today as well. It is a pleasure to be joined by such esteemed panelists, and thank you so much for taking the time to talk to us today around implementing the European Green Deal. I'm Ellie Groves, Managing Director for the Economic and Monetary Policy Institute here at OMFIF. I'm very pleased to be joined by Nicholas Mackel, CEO of Luxembourg for Finance, the Agency for the Development of a Financial Centre. We also have Martin Spock, the Director General for Financial Stability in the Financial Services and Capital Markets Department at European Commission. Jakob von Weizsäcker, who is the Chief Economist for the Federal Ministry of Finance in Germany, and Delphine Derat, Senior Manager Governor Relations and Regulatory Strategy at the London Stock Exchange Group. So thank you all for joining us. Today, we're going to be talking around how we can get to net zero by 2050. We'll be talking around data, as I recently moderated a session looking at this topic, and one of the speakers said, if data doesn't come up in the first few minutes, there is no point in having the discussion. So we maybe not bring it up in the first few minutes, but definitely will later. The other conversation that I really want to have is how we move from sustainability agenda and the net zero targets, going from best practice to common practice, especially within the financial services industry. So how do we get there? First of all, I want to ask Nicholas, what is within the financial services industry? What are for the companies themselves? What is reasonable to ask them? What should they be doing to put forward this agenda from the perspective of yourselves in the Luxembourg for Finance? So, Nicholas, please do have, with a few examples, what is happening in the financial service industry and how can we move forward to implementing the European Green Deal?
Well, I think, first of all, thank you very much for the invitation. I think a lot has already happened. It is true that, as you probably know, much of what is the objective of the Green Deal will require investments on a scale that governments will not be able to stand themselves. And in fact, one could turn that around and say there would be no Green Deal without the financial industry indeed. Where is the financial industry on this? I think we are only at the beginning of a process. Just the same way as governments are more or less after Paris in December 2015, coming to terms to what it is they are ready to commit to in terms of reduction of carbon emissions. The financial industry is accompanying that transition. And I think that is the first element that is very important, expectation management. You read a lot of comments that say, well, yes, but the financial industry is still financing industries that are emitting carbon emissions. Well, yes, obviously, if we say that by 2050 we will be carbon neutral, and if we say that by 2030 we will reduce our emissions by 55% compared to 1990, it shows that this is a transition, and the financial industry cannot just switch everything and all investments to carbon neutral, because that would mean that the industry, which was given time to pivot into the carbon neutrality by governments, would be deprived of the financial oxygen in order to continue functioning. I think that is a very important point. Now, this being said, a lot has already happened. So when Greta Thunberg 2 days ago made a big splash by saying it's all been blah, 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 I think when Martin will speak afterwards, he is certainly one person who has done a lot that is not blah, blah, blah. And you can ask the financial industry. What he has managed to do is to get the industry away from overselling probably what it does in terms of sustainability, to really getting their act together by providing a framework within which they operate. And today what we see is that whether they are asset managers or investors such as insurance companies, banks, and many others, what they are doing is really they accompany this transition by talking to the industry, talking to the companies that make our economy and helping and assisting them in this transition. And that is the role of the financial industry. It has always been to help finance the economy. Now the economy is transitioning or pivoting into a carbon neutral economy, and the financial industry is there to assist their clients in the economy in managing this transition. As I said at the beginning, we're only at the beginning of a process. A recent study by Morningstar on behalf of the Luxembourg Investment Fund industry shows that, for instance, 11% only of European assets under management are sustainable funds. But the positive news is that 52% of net inflows go into these. So more than €1 in two. That is a positive news in and of itself. The same goes for capital markets. I think if you look at the absolute share of green bonds or sustainable bonds in global capital markets, it's very limited, but the tendency, the growth rate is very positive. So that in and of itself, I think is worth celebrating, together with what has been done in the regulatory sphere, where Europe has managed to set standards, and we all bow in recognition before what Martin and his team have achieved.
Thank you very much. And that's a perfect segue to ask Martin to outline what you have achieved as head of the Department for Sustainable Finance Department in the Director General. And it would be also useful to talk around the strategy with financial services on sustainability. So what you have achieved, but also looking forward to what you are hoping to achieve to push forward the process and targets surrounding implementing the European Green Deal.
Thank you very much, Ellie, and thank you, Nicola, for this excellent framing. Well, I would like actually to talk not only about what we have achieved as policymakers and regulators, but I would like to emphasize that this project obviously requires a very strong partnership between the policymakers, regulators, and the private sector. And Nicolas mentioned, how important it is that the financial sector really plays, what kind of role they have to play, not only in assisting the businesses on their transition pathways to sustainability, but also the financial sector itself has to transform itself and align with the targets. We are talking all about these targets. Now we also have, law in the European Union, how to achieve climate neutrality, but these goals have to be translated, and everything, that we do, not only we as policymakers, but also stakeholders on the ground. And I think that the framing that Nicola presented is an excellent one. Now, what we have achieved since 2018, because I should say that, we have basically started to work on sustainable finance, not when the European Green Deal came, but we started already 3 years ago, before the European Green Deal started, which I think, gave us really a lot of advantage, because then, our thinking at this current juncture is much more advanced. What we have achieved since 2018 is that we have established foundations for sustainable finance. We presented back in 2018 a very comprehensive strategy on sustainable finance, which was a combination of regulatory reforms, but also some enabling frameworks and tools. Just to name a few, the EU taxonomy, which is supposed to define what is ultimately aligned with the climate and environmental targets, disclosures, how to reinforce transparency. This is where we also decided to regulate. And obviously, we have also developed some tools, such as green bond standards, climate benchmarks. We are now working on other tools, such as labels. So we did want to make sure that the financial sector has an appropriate set of tools and frameworks that would allow them to do their job. Now, the time has moved, and now, because we have the European Green Deal as the first and really the most important priority for the Commission, we also had to scale up the ambition. it is true, and I would certainly agree with Nicola that it has not been only blah blah, and certainly also the sector has moved a lot. But if we ask the question, are we there where we should be? No. And that's exactly why also in the recovery context that we are now after the crisis, we came up with a new strategy 3 years after 2018. We call it Renewed Sustainable Finance Strategy. That is obviously leveraging on all the great progress achieved in the 3 areas I mentioned, but it also identifies gaps. And again, I mean, I will be very quick. In 1 minute, I mean, we have identified 4 main areas where we see gaps. The first one is transition, how to recognize better the different starting points of stakeholders on their transition, because I mean, so far we have really pushed everyone to get to the fully sustainable space, and that should be the primary objectives. But we do need to recognize better the intermediate steps that stakeholders are taking towards achieving those targets. So while there is absolutely no doubt about the need to achieve all those targets, and everybody has to achieve those targets, we just need to cater for different pathways how to achieve those targets. The second area where we have a gap is inclusion. We do want to embrace better retail investors, consumers, SMEs, businesses into this agenda in a positive way, because so far we have not really managed to do so. The third area, which I think, I mean, is really important, is how to make sure that the financial sector on its own is resilient enough to withstand the climate change risks and environmental degradation risks and their reinforcement, and also how the financial sector itself can contribute to meeting the targets. And finally, global dimension. We have identified the need to really scale up our efforts also at a global fora, how to converge on these different tools and frameworks that are being established in different jurisdictions. So the strategy that we presented in July is providing for a new comprehensive vision, which I think is much more mature than anything we have done before. But the ultimate success of this strategy depends not only on us, the Commission, but ultimately on policymakers, on the co-legislators, on the member states, the Parliament, but in the first place on the financial sector itself. Thank you.
Thank you. I want to go to Jakob. Do you share the sentiment that we are not where we should be currently? And how can we speed up to get there, especially looking at the nation states, but also touching on the G7 and G20, the common ideas and common strategies? One of the discussions I want to have a little bit later, so to think about it, is do we have a common language? So we talk about the taxonomy. So if you want to bring in that as well, is everyone on the same page, and how can we get them there? But Jakob.
Yeah, thank you very much. I think it's very important to think about what governments can do and what the private sector can do. And of course, privately funding private investment in low carbon and then no carbon emissions, that's an important part of the story. But of course, the truth of the matter is part of the reason why the financial sector is so enthusiastically embracing green finance is because of the very high degree of competition in wealth management and extremely low margins. And green finance is a higher margin business in terms of wealth management. Nicholas will know this from Luxembourg, and that is of course part of the reason why there's so much enthusiasm. Now, if it were to turn out that these investments were more expensive in terms of fees, but not terribly profitable because governments are lagging behind in terms of CO2 pricing, in terms of regulation, in terms of providing the right sorts of infrastructures, in terms of doing what is necessary. By the way, Martin, of course, that's an important part of the agenda, making sure that electrification actually works. So that has important policy implications at the national and European level. We'd end up in a very embarrassing situation where we haven't saved the climate, where green investment was less profitable than other types of investment, and the only outcome would have been slightly higher fee for certain service providers. And that would be, of course, deeply unsatisfactory, and that's definitely not the way we wish to go. And so I think one of the advantages is if one starts this conversation, Ellie, from the green finance angle, is if, for example, pension funds are greening themselves, and then pensioners are saying, look, or future pensioners, look, we're doing what is the right thing for this planet. And we also want to make certain that this is the right thing for the future of our pensions. I think in terms of political sustainability, we create a very powerful momentum to do what is necessary in the political sphere as well. And by the way, to sort of half quote Jean-Claude Juncker, to get re-elected nevertheless. And so I think that's an important link of how things are fitting together. At the global level, Ellie, and of course you were probing sort of at the global level, I think one very important question is, to what extent can we create some sort of climate club? It's something that my minister has called for, because of course, which will be the case, for the foreseeable future, there will be significant differences in carbon pricing in different regions of the world, and we end up having either purely national or just European solutions. And I think it's perfectly understandable, given these price differences, that we have the CBAM proposal, Carbon Border Adjustment Mechanism, for those of you who don't deal with these things every day. But of course, implementing these mechanisms in a good way is extremely hard. And it would make life so much easier if the Carbon Club weren't just going to be our single market inside the EU, but were to be a significant share of the global economy. And so I think that is going to be an important part of what we'll strive for. And it's definitely going to be an important part of Germany's G7 presidency. But this can't just be a G7 agenda. And the word club maybe is even a dangerous one in that context, because it suggests, rich people shielding themselves from the rest of the world. But of course, it needs to be very much inclusive, and it needs to include emerging economies. It needs to include the lowest income countries, to the extent that they have a credible climate strategy. And of course, as part of that club, we can even help them make some of those transitions. So I think that's very much the global vision we should strive for, building on, and I should mention that in closing for my first statement, the enormous achievement of the Paris Agreement, and building hopefully on the momentum that we'll be getting from Glasgow.
I was going to actually just quickly follow up with you, if I may, Jakob, but on that Carbon Club, do you see that being possible, and would we have China or not have China in that club, considering the conversations that I'm sure you've been having within the G20? So is that something that you think is realistic, that there will be a Carbon Club with China involved actively?
I mean, first of all, in the very short run, it is not easy to build that club. I mean, if our target were to build it by the end of next year, I think we would fail. And we will not only fail with regards to some emerging economies, including China, but we'd also fail transatlantically, because, of course, the Biden administration is struggling domestically to introduce a carbon price, even though they're very active. And if they manage to sort out their troubles in Congress, they'll be even more active in successfully doing what it takes to really restart the climate agenda in the US that suffered a bit of a setback under the previous administration. But however, we look at that question more in the medium term, with a sort of 3 to 5 year time horizon, which, by the way, is a short period of time for anything multilateral or even global, then I'd be cautiously optimistic that if we start this discussion now, if we avoid some of the obvious pitfalls, including, the notion this is a rich men's and women's club, including the notion that we have to have a perfect setup. I think the perfect would be the enemy of the good. If we start to do some analytical work, and I think the OECD is really starting to do that, comparing the different regimes of carbon pricing, regulation, etc., around the world, and what that implies, both in terms of climate impact and in terms of competitiveness. I think we're creating a basis and momentum in order to get there. So in other words, yes, I think it's doable, but not in the very short run. So we need to be very clear, this is not something that's going to happen tomorrow, but if we don't start it today, we won't even have it in 5 years from now. And given our climate ambitions, given our, in Germany, even 2045 target, at the European level 2050 target, we urgently need this at the very latest in the late 2020s.
Thank you. And actually that brings us quite nicely on to Delphine. The OMFIF and the London Stock Exchange Group have worked on putting out a paper on the looking at the role of sustainable data in a lot of really pushing forward. And I think one of the things that we were discussing within this is exactly what Jakob was saying: do not let the perfect get in the way of the good. And actually I think that that's very important. So it would be interesting to give your views on kind of building together, both from your perspective at the stock exchange, the need for the financial service industry to step forward, but what is needed with the policymakers? How do we track the data? How do we give that common language and really look into the future?
Thanks. Well, I think that everything here today understands the role of financial markets in avoiding, of course, worst case climate scenarios. And our sector of finance is for sure the only mechanism that can mobilize the trillions needed to transition our economy to a net zero future. And if we want to direct capital towards green activities, investors and banks need comparable, comprehensive and complete data to take the right investment decisions. We are making some progress on data, of course. However, well, it was mentioned, it is still imperfect. Data is missing, and investors, asset managers, banks, but also public authorities need also to project the impact of climate change on financial markets and portfolios. And to do that, we need forward-looking data to accurately measure and manage risk exposures and determine asset values for a sustainable future. But while forward-looking data is needed, there are some issues about credibility, confidentiality, and quality that the financial sector face when using these projections. It's also very, of course, difficult for companies to publish this kind of information because they can face legal issues. So what we observe and what is very interesting is that we may find targets for the next 5 years. We also have commitments for 2050, but the real challenge is in setting accountable, actionable targets for the next 5 to 30 years, actually. So this is where we are missing the information. So we believe that issuers will need clearer legal frameworks and templates to report on this information. And of course, I hope that the forthcoming regulations, so in particular the CSRD in the EU, but also at global level, the TCFD, will help companies to do that and to report on this information. So as you mentioned, we prepared a report, LSEG and OMFIF, with a focus on forward-looking data. It was published yesterday. This is food for thought. We have interviewed different stakeholders to better understand the state of art and their expectations. And we conclude with some considerations for policymakers and regulators. So I invite, of course, my co-panelists and the public, the audience, to read it.
Thank you very much. We have a question from the audience, which I'm very pleased to see, and also to encourage those who are listening in to keep putting their questions. But it might be one for Martin to pick up on. Is it conceivable that the global carbon border adjustment mechanism could be levied and the money used would help the LDC in achieving their transition through a climate fund at the World Bank level, for instance, rather than the money being used to plug the gap in rich countries' debt? That was from the audience. But in less developed countries, do we think that actually a global CVAM might be useful? Martin, if you offer your thoughts, and then maybe go to Jakob as well.
Thank you, Elia. I think that this is obviously something that is rather for the top level of the Commission and obviously other masters, political leaders of other jurisdictions to contemplate on. But what I can say is that, I mean, at least that's where my expertise lies, is that we have actually started to create this club on climate that Jakob was referring to, at least when it comes to sustainable finance. Obviously, he made the point that sustainable finance is only one part of the piece of the puzzle. We do need to have other policies. Carbon pricing is obviously one of them. But since I am personally working on sustainable finance, where my competence is, what we have done so far, actually, we have done already a lot, and we have created a club that Jakob was talking about for sustainable finance. We have created so-called international platform on sustainable finance, where we have gathered like-minded jurisdictions that are developing their frameworks and tools for sustainable finance, such as taxonomies, disclosures, standards. And we are discussing not only who is doing what, but also how to converge on those standards. Now, Jakob was raising the point, we need to do this across the board, I understood. And I think there, I would agree, because the effectiveness of sustainable finance policies also depends on the effectiveness of the other policies. And if you ask me, is there a case to coordinate also the other policies? I personally would certainly say yes. But of course, again, this is not necessarily where my competence is. So I would rather leave it open at this stage rather than committing the Commission to do one thing or another. Thank you.
Jakob.
Yeah, so I think Martin is absolutely right that the sustainable finance discussion, which of course on its own is not going to be enough, is really pioneering this kind of international cooperation that we require on the sort of hard and fast, rules and regulations, especially pricing, in order for this whole package to work. I think one can learn a lot from that. And with regards specifically to the question, yes, of course, part of the deal could very well be that countries wishing to join such a club could be told, look, if you have, say, a steel sector that is struggling to transform, and the country question happens to be one of the poorer countries in this planet, that perhaps a suitable fund, possibly administered multilaterally, that's really then an important practical detail, could say, look, we offer you this as a package deal. And it's almost a little bit like, I have to be careful with this audience, but a little bit like the kind of help that countries are getting wishing to exceed the European Union. And so I think in similar ways, there could be a sort of financial package for sectoral transformations that often make it politically very difficult, be it in the coal sector, be it in the steel sector, be it in some energy intensive chemical sectors, to try and help countries accede to the club. And one of the big advantages from the perspective of OECD countries in that context would be, it would be much more clear what one is getting. And I think one would be much more willing to commit serious resources, because as you know, in the context of the Paris Agreement, we are all struggling with this promise of 100 billion per year, but this 100 billion in any event is adding apples and oranges and all kinds of different fruit. And if one thinks about it in terms of net present value, if one were to get to the 100 billion in net present value terms, it would be a much, much smaller amount. So I think part of the idea would really be to build on the Paris Agreement and have something where countries in a position to provide funds for transition elsewhere, they would really know what they would be getting, and I think that could be potentially extremely helpful. So in other words, I agree with the idea that put implicit in the question that was asked.
Thank you, Nicholas. I want to come to you to touch on this, but also, do you think that the sustainable finance agenda in both the kind of, when you're looking at the Commission, but also the nation states and what we've spoken about in a climate club, as you mentioned earlier, there will be that the financial service industry has a huge responsibility within the climate agenda, but also there is a responsibility to ensure that their financing towards net zero is supported as well. So kind of and do you feel that it goes far enough? What would you like to see out of COP, out of G20 to make sure that the financial industry's perspective is supported towards this common goal? We all seem to agree, and I'm sure nobody here and nobody listening doesn't want us to get to net zero in 2050, but there are some hard realities that are needed to get us there, especially in transitioning. Decarbonisation in the energy industry is going to be not an easy ride. So do you feel that support is there?
I mean, to answer your question relatively straightforward, I think, I don't know what Martin thinks, but I do think that there is the support of the financial industry for the agenda of the Commission. I think they have really committed to it. They have really, French you would say, ils ont mordu, they bit into it. Why? Because, and I will swing back to something Jacob said before, because they understand this is something that is here for the long term and that is client driven and investor driven. It's not only something where they can ask for a higher fee, it is really something that is a very fundamental shift in the finance industry. And I think most, probably all professionals in this industry have also understood, as Mark Carney keeps repeating, this is an opportunity for the financial industry. Take what Jacob has just talked about, the way you could engage with certain countries and how you could help them. Well, you do what Martin said before, create a partnership also with the financial industry, because they may also have an interest in helping to finance what it is you want to build in these countries, or how you want these countries to be able to transition their industries away. And I think if we manage to build and reinforce that tripod between the recipient, those countries that want to help, and the financial industry, you will get much further. It's not only a country-to-country project, but you can certainly bring in the private sector. You can bring in the private sector in multiple different ways. I think if you look at it, the way the financial industry has responded to the SFDR, the disclosure regulation, I think they all have cleaned up their acts. You had an article recently on, I think it was Bloomberg, about this, because everybody wants to be clean. We were talking before about data. Why is data so important? Because data creates transparency that then creates trust in the market. And that is where you want to get. That your investors, your shareholders, your clients have trust in your products.
Martin, you want to come in on that, but I also want to pick up on, I think that I agree with you, everyone wants to be clean, but is there a risk that that companies in the current will be seen as being green rather than actually being green? And what I'm talking about, the risk of greenwashing, and what are the active steps that need to be taken to ensure that even that concern of consumers or those that is tackled, that actually what is the data disclosures that is helpful to ensure that there isn't greenwashing, rather than going through the motions and being seen to be green. I guess actually, Nicholas, do you have anything to say say to that? But then I want to go to Delphine on that, because
I think Martin is in a much better position than me, but because he helped create a framework that will, for the future, or as of now, help to avoid this sort of risk. But there were already other examples. I think wherever you see serious players, you saw that what they understood was that in order to gain credibility, you needed to have a credible process. We celebrated yesterday in Luxembourg the 5th anniversary of the Luxembourg Green Exchange. They are the world leader in green bond listings. How did they manage to do that? By setting up a process and criteria that gained them the confidence of market makers such as the World Bank, many others as well. Now you also see, I don't want to talk about a very large German asset manager, other examples, but I think that's growing pains a little bit of this process of getting there. And with the framework that the industry now has been given and has embraced, I think we're slowly seeing probably this kind of examples not happening anymore, should not. I think the rules are being made clear, the market is maturing into this, and I think that is the important part.
Thank you. Martin, you wanted to come in on the last question, but also on that ensuring against greenwashing. What is what are the actions that you're doing to encourage climate disclosures from companies, but at the same time making sure that those disclosures are rest assuring that there isn't the greenwashing? They're not just being seen to be green, but are actually being green.
Thank you, Ellie. I just would like to complement what Nicola said. I mean, yes, absolutely. We do feel that there is a support from the financial sector for this agenda. Obviously, we are discussing, the details. I mean, whether, sometimes, of course, stakeholders argue that we might be going too far, that when it comes to what we expect the financial sector to do. But overall, I think that what Nicola said is absolutely right. There is a support, and they see this project as an opportunity. Now, what I would like to actually add to that point is that what we have seen is that it is important not only to have the kind of dialogue between policymakers, regulators, and the financial sector, which has been, or which was, or used to be the origin of how the sustainable finance was created, but also we need to bring on board other stakeholders. And, I have mentioned that the second pillar of our new strategy is inclusiveness. And here, I think it would be also very helpful if this conversation we are having now between the regulators, policymakers, and the financial sector is also extended to the businesses. And that also the businesses see this the same way as the financial sector. This is an opportunity, and they don't see it as a kind of, oh my God, the financial sector is now subject to stricter rules and it's a threat. It's a threat for me. What we still, I think, need to do collectively is to create an environment where also the businesses would see this project as an opportunity, and that they see that the financial sector can support them on the transition. So, I know it sounds a little bit like a cliche, but I think that this is where exactly we are not yet there. And, if we kind of present and twist the whole agenda in a more positive spin, which again, obviously, the financial sector needs to do, more, I think that it would be really much better. Now, on your question on the greenwashing, yesterday I spent the whole hour, speaking publicly about what we have done. Very quickly, we have, the three elements of our previous strategy: the taxonomy, the transparency, the standards, and the labels on which we are working are specific examples of what we have done to combat greenwashing. Now, has the risk gone away? No, because there is a boost of sustainable products and products that are being sold as sustainable, which is good. But then we also need to kind of cater for this risk, not only with regulations, but also by making sure that the rules are implemented. So when I talked about the new strategy, we have emphasized the importance of also looking into the supervisory powers. Are actually supervisors equipped enough at the European level to tackle the risk of greenwashing? Are actually the ESAs, the European supervisory agencies, having actually the right tools? And, are we actually understanding, are we monitoring these risks? No, we are not yet. So we have proposed a couple of actions in our new strategy, which are supposed to not only regulate, but now also improve, the monitoring and assessing whether we might need to go even further when it comes to the supervisory powers on greenwashing. Thank you.
Thank you. Delphine, I want to come to you to talk about the forward-looking data. So I think that this links a lot to what the conversations have been, is what is needed to ensure that we get to the climate neutral in 2050, and how do we change the way we look at data, I think is the key question. And what do we mean when we say forward-looking data, and how does that feed into the greenwashing and maintaining and the supervisionary questions?
Well, I think that, of course, I agree with my colleague, the fact that, well, this is only by all parties working together that we can reach the outcomes that we are seeking globally. It's common sense to say that, but it's true, and it's not only words. In practice, it's extremely hard to reach this cooperation. And well, talking about the greenwashing and the risk of fragmentation, I think that the EU has a responsibility to push for consistency and harmonization. And when I say the EU, I also consider that LSEG, as a global group present in the EU, has a role to play here. About greenwashing and data, I think that what we need and what is the key driver of rapid and sustainable change will be the increasing coalescence of taxonomies and disclosure standards, taking into account, of course, forward-looking data, to common standards that all institutions and companies can follow around the globe. As a former regulator, but equally importantly as a member of the London Stock Exchange, it is important to establish this common language for sustainable investment and stop greenwashing. However, I also think that we need to be pragmatic here, and I guess that Martin knows that better than me, but if, for example, the US adopt a taxonomy, it will probably not be as granular as the EU taxonomy. I have no indication about what the UK taxonomy will be and its alignment with the EU taxonomy, but we all need to ensure the interoperability of existing and future taxonomies. So I think this is our responsibility for all of us. And well, we do have a positive example with accounting standards. So it means that it's possible, but without this, we risk a fragmented approach, which ultimately results in poor outcomes for all of us. And same, I also wanted to mention the risk I see about, for example, SFDR and the risks that national regulators now are also adding some guidance on top of the EU regulations, and the risk that it's going to be very difficult for actors to also to implement the rules, because they will have all the EU rules plus some national guidance. So here I also think that we need to some cooperation between regulators and the EU. Talking about also greenwashing and how do we identify companies and how do we ensure that the virtuous issuers have access to financing. We also at the LSEG have a segment for sustainable bond markets, which is of course a good way to improve access, flexibility, but also transparency for investors, as we require issuers to disclose information on the use of proceeds, etc. And I think this is not only marketing. I think this is really helpful to identify green debt investments. And what I find also interesting is that we created what we call the Green Economy Mark, which is a label for listed companies that generate between 50 and 100% of their revenues from green environmental products and services. And to calculate that, we use our in-house taxonomy, the green revenue model. And well, I find this system quite unique and very interesting also for companies. It was mentioned by Martin, we also need to embark SMEs and companies in this journey. I guess this kind of system or labels is important. And we also, what is extremely important is also to embark companies that might be carbon intensive. We also think that it's extremely important to engage with these issuers, in particular if they are making significant and responsible moves to transition their business models. Of course, we also want to recognize that. So this is why we also created a market segment for climate transition. We all need to have a holistic view and to take into account where the companies are in this journey, and we should also try to facilitate issuers' life. And to conclude on forward-looking data, of course, as I mentioned, it's it's not easy for the timing for companies to disclose this kind of information because of legal issues or responsibility issues. So yeah, regulators and policymakers have a role to play here. They have to precisely define what is forward-looking information. And it's a bit what we do for profit forecast or estimates. We already have an existing we have existing guidelines about that for companies, and this is extremely helpful for them because without that, they do not disclose information because they are not sure what they can say and the risk that they take. So yeah, we need to have a clear definition of what it is in the regulations, and we need to have some guidance for them about what they can say or not, and something like written and precise enough for them, and it will be of course very useful in the end for the financial sector as a whole.
Thank you very much. Jakob, I want to slightly shift to a question that is a little wider. What lessons have sort of Germany, and especially in the you think European at a policy level and a government level, have taken from the COVID crisis? So we have seen that obviously when the COVID crisis happened, it was a health crisis turned into an economic crisis, and there's now an understanding that a lot of spend needs to happen to ensure the transition earlier than when the crisis happens. So how are you, as financing options within Germany, looking at the opportunity that from COVID, so the next gen EU funding, and also the policies that you as in the Treasury are putting towards decarbonizing your economy, and how are you supporting that transition so there won't be so the climate crisis is not as bad as it could be? Let's put it that way.
Yeah, a very, very interesting question. And I think the first observation to make is that when one goes back a decade to the financial crisis, then of course many countries somehow had this idea, including Germany, by the way, had this idea: we need to weather the storm, and then we'll go back to where we were before the crisis. And that meant a lot of measures that would help going back to where one was before. And if one looks at the stimulus packages at the time, I think it's fair to say that reflected to some extent this idea, which perhaps was the right idea. Perhaps one could have thought 10 years ago that perhaps the climate crisis was already looming large, and one could have used this opportunity to accelerate a transition, but that wasn't really done to the extent that perhaps with hindsight one wished it would have been the case. But now in this crisis, we managed in Germany in our stimulus package in early June 2020, which was a rather large stimulus package, to have 1/3 of expenditures basically dedicated to longer run investments and transition subsidies, if you will, for energy transition. And so that was, I think, a market change. I think it was good macroeconomics because it did help stabilize expectations of investors and consumers and so on. And at the same time, it was very clear we're changing course and we're steering in a direction. And Germany, we're particularly lucky because we had this climate cabinet set up. So a lot of the things that we then invest a lot of money in had been conceived as ideas within the government even before that. So even though these projects are not always shovel ready, they were decision ready, and we just needed to put the money to it in order to make them happen. And I think it's fair to say that at the European level, with Next Generation EU, we managed to make certain that even for countries fiscally somewhat more challenged, it was possible to do exactly the same. In other words, to have as an important part of the short run stabilization measures an element, an important element designed to really push energy transition. And I think it's fair to say, if you look at the rules and regulations of the recovery and resolution plans, and a lot of work has gone into them in all member states. If you add the 37% of green investment plus the 20% of digital investment, and most countries, of course, far exceed these targets, I think you get a fairly good idea of what we got right. And secondly, I think that's another interesting dimension. The talk of the town in policy circles these days is resilience. And resilience can mean, I think, a lot of very sensible things. It can mean a pandemic preparedness. So not only talking about preparing for the next pandemic, but actually doing it. It can mean organizing one's links with other companies in ways that are somewhat less prone to disruption. By the way, resilience can also mean bad things. Some people take it to mean autarky and protectionism. That would be very wrong and very dangerous. But making one's production networks more resilient, that is a good idea. And I think resilience is also an extremely helpful way to think about the environmental challenge. Because, of course, we don't know exactly what the future, even on the climate front, if we pursue hopefully something close to the 1.5% target, will imply. But certainly, I think thinking about it in terms of resilience and climate risks will help us a lot. Really pull through with that agenda rather than falling short of what needs to be done. And so I think even though it was, of course, a very dramatic crisis and it's still going on, some of the lessons I think we are drawing from that crisis will be very helpful to move us forward, both with regards to preparing for a possible next pandemic. We need first to deal with this one and really tackling climate change.
Thank you. We are coming up to sort of the final 8 minutes. And actually what you were just saying there, Jakob, had a thumbs up from Martin, which is excellent. And I believe from a few of those on the panel too. One of the questions we've had in actually links to that resilience topic that you were just talking about, looking at when we are focusing on the green agenda, at what there might be some costs, for example, using the example of planting trees which are the wrong type in the wrong place, or if we narrowly focus on just the green aspect of what is needed, is that at the risk of not engaging with biodiversity, the social lens that is needed, sort of the wider ESG implications? And actually, how did those feed into your sustainable finance agenda? So maybe Martin, talking to you around some of the conversations we've had, the European Green Deal, how does it engage with the biodiversity questions, with the resilience question, exactly, with the social aspect, and how does even healthcare come into that? So it's very good to have a carbon lens, but how does that fit into the rest of the story?
Thank you very much, Ellie. Excellent question. We have indeed covered the whole ESG spectrum with our first strategy back in 2018, but we did prioritize climate change and environmental objectives. I didn't obviously forget the social part, but for the time being, because, for instance, the work on taxonomy is so demanding and complex, we had prioritized the criteria for the climate objectives in view of the urgency, but there is a clear plan, there is a sequence. So to give you an example, now we have finalized the first basically list of economic activities that substantially contribute to the climate objectives. But at the same time, in order to avoid harm being caused for the other environmental objectives that are not climate, such as biodiversity that you mentioned, the criteria have to basically comply with the requirement of do not significant harm. So what that means that if you contribute substantially to the climate objectives, this activity must not harm, let's say, biodiversity or let's say water or circular economy. This concept is already inbuilt in the project, but now it's clear that we also need to proceed to the second stage, which is the other 4 environmental objectives such as circular economy, protection of water, prevention of pollution, and biodiversity. We are going to, and we are currently working together with our group, the Platform on Sustainable Finance, on those criteria, and we are supposed to adopt delegated act, which is the list of those criteria already next year. And finally, I should also say that the social dimension has not been neglected. Even in the climate taxonomy, there are some minimum social safeguards that have to be complied with. So we don't want, that the financial sector says, I have an excellent green product, but at the same time, this product is being sold at the cost of very negative implications for the social dimension. So there are some minimum social safeguards. I'm not saying that it's kind of 100% coverage across the board, but these hooks and safeguards have been built. But it's clear that now with the new agenda, we do need to proceed also with the other dimensions, which is non-climate objectives under the environmental objective and the social objectives. We are currently, by the way, examining the case whether we should extend the taxonomy also to social objectives. The Commission has not yet decided this, but the Platform on Sustainable Finance is going to submit a report whether there is a case to extend taxonomy also to social objectives. Thank you.
Thank you. We've had another question that's come in, which I want to quickly get to and ask Nicholas. So there have been some of the financial sector highlighting issues surrounding the over-financialization of climate change, that ultimately until more regulation is put on the real economy, there's only so much the financial sector can actually do, especially for diversified banks or asset managers that broadly reflect the markets in which they operate. Do you agree, or what are your thinkings around the role of those in the financial sector? I guess it goes back to that question that we were talking about. Should they be driving the agenda, or should policymakers be driving the agenda? And how much can we realistically expect the financial sector to do?
It's a very interesting question because it's very complex. I don't think that it should only be driven by policymakers, although policymakers are setting also the pace at which this change is happening and how we create the framework. But then I think what the Commission does very well, it binds in the financial industry in its reflection process and then in the drafting, because simply you cannot define regulation without the input of those that actually have to help you implement it. This is not a case of asking turkeys what they think of Christmas. This is simply common sense. I don't think it can be driven by the financial industry either. That will not go fast enough, probably. So there needs to be, as we discussed at various instances during the last hour, a partnership between policymakers, between regulators, between the financial industry and what other people would call the real economy, i.e. those that are being financed by the financial industry. And then we move forward, and we need to speed up the pace.
Thank you very much. We are wrapping up and we are very pleased that the next session will be with the Governor of Banca d'Italia and OMPIF Chairman David Marsh. Before we do, I just want to say that we had some polls going out throughout this discussion. Is nuclear energy a viable source of renewable energy and a way to achieve decarbonisation? 86% says yes, 14% says no. Jakob, I was going to come to you for that question around, is nuclear energy a viable option? But we don't have time, so you're saved there. Then can the EU achieve decarbonisation of the entire energy industry by 2050? 17% yes, 83 no. So hopefully we can, Martin, you can alleviate some fears on that. And we're all working towards that. And then can the EU be climate neutral by 2050? We're split there, 50% yes, 50% no. So Delphine, I'm going to ask you, what is the one thing that would really help for the EU to be climate neutral by 2050 with your forward-looking data in 30 seconds?
Well, that's not a gift. No, but yeah.
Sorry.
Sorry, Jakob.
No, please, Delphine.
I would say, of course, here I actually think that that regulators and policymakers have a key role to play. So I would say a precise and specific framework, legal framework for issuers. I guess this would be the top priority.
Perfect. And all speaking the same language, so engaging with technology and data to get there, I think is very key. So Jakob, please.
I was going to say innovation and to an important extent electrification. And just to come back on the nuclear, I think private investors are quite helpful on that front, because I think you'd be hard pushed to find large-scale nuclear projects that are privately funded. And if, for example, you look at the UK, the colossal cost of the most recent nuclear project, I think may serve as a warning. And so I'm not sure whether the results of the poll are reflected in what private investors might be willing to do. And by contrast, I think other ways of generating electricity tend to be lower cost alternatives, even without emitting CO2. That's it from my side.
Excellent. Well, I think still more to discuss, and it's been very interesting to have you all here. So thank you so much. And listeners, thank you very much, and stay on the line for the other discussions. As I said, David Marsh, over to you. Thank you.
Thank you, Ellie.